The stock market is pushing almost brand new all-time highs, but I would be venturing to say that this is the exact moment when this rally becomes dangerous. Now, I know that's a big proposition right here, but hear me out. There's a lot breaking underneath the surface that you cannot see in the price of the market alone. The first thing to keep in mind is that the market breadth is starting to crack. Now, inside of OVTLYR, what we have here is measuring the number of buy signals versus sell signals. Now, we cover over 9,000 stocks, and you can see when things are moving up, that means we're getting more and more buy signals. And when it crosses bearishly, we're getting more and more sell signals. So we're about to have that crossover. I would imagine it could be as soon as tomorrow. Another thing to notice is we're seeing less uptrends and more downtrends. Now, this is on the total stocks that we cover. If we break it down into the individual sectors, we see even more surface pressure, even more things going on. So first, the technology sector. The technology sector has been super strong for a while, and we all know that they've been the big winners in the market recently. But right here, we can see a peak in breadth and starting to contract. We're also seeing less uptrends, more downtrends. That's not what you want to see. If the big leaders, the ones that have pushed the market up higher and higher and higher, are starting to crack, that is not a good sign. Now, I do want to point out that we used to have significantly more. There are 11 sectors in the market. Today, I would say roughly half of them have already flipped bearish. And in fact, if you look at the S&P 500, the 500 stocks in the S&P 500, that is about to flip bearish as well. So we have a lot breaking down under the surface. Now, it looks like everything's great, right? But if we take a look under the surface here at the MMFI, this is the percent of stocks above their own 50-day moving average, is falling hard. In fact, it looks like it may be super close to breaking down to a new level, a new low right here. So what this means is that these are the number of stocks that are losing their uptrends. And with the 200-day, the MMTH, similar situation here. Not quite to that point here, but if these break down under 50%, looks like MMFI just went under 50%, that is a bad sign. That means less than half of the market is trending upward. Okay, that's not so good. What about new highs and new lows? Another thing that's not so good. We're seeing less new highs moving towards the weak participation. We're seeing more new lows leaving the area that's considered bullish for stocks and pushing in the opposite direction. So this is what I am saying, is that I think we are at a pivotal point right here where the market is starting to turn right before your eyes. And in fact, inside of OVTLYR, you can see the market fear and greed has turned a while ago. And what I'm trying to get across here is that there's an imbalance between fear and greed that drives the market. And we have had that imbalance flip, and it's starting to get more fearful. The fear and greed on average in the S&P 500 has already started to go down. The fear and greed itself on the index is going down, and on average, everybody inside the index is starting to go down as well. And we're about to have bearish breadth flip in just a moment. And on the NASDAQ, same story. It's been getting less and less greedy, more and more fearful. Same for the average of everybody in the NASDAQ. And this has already flipped with bearish breadth, more sell signals than buy signals. And what I wanted to look at here, looking down on the sectors, is that the biggest high-flying stocks that there ever were the absolute worst performers today. The tech sector itself, of all the sectors, was the worst performer of the day. And if we zoom in deeper, who were the ones performing the worst? Computer hardware and semiconductors. Just like 10 minutes ago, is what it feels like, computer hardware and semiconductors were the only two stocks that were driving up the market. Now they're the biggest losers on the day. In fact, you've got Broadcom, you've got Micron, you've got ARM, you've got ASX, you've got QCOM, you've got United Microelectronics. You've got lots of stocks that are actually getting pretty beat up pretty hard. And that's just in the semiconductors. And then we transition over to the computer hardware. Similar story. You've got ANET, IonQ, SanDisk. Some of these stocks were impossible to break not that long ago. And now the sector is the leading sector going down. So again, while it feels like everything's great, Well, it feels like, oh, you can't get any better than this, right? The problem that we see is that we need everything priced to perfection. Maybe you've heard that term before. And when there starts to be cracks under the surface, the perfection is no longer there. The perfection is no longer there. So taking a look at it from a different perspective, one area that I really think people need to be starting to take a look at is the consumer defensive. Now, jumping into the consumer defensive, these stocks have been beaten up. I'll be the first to tell you, they've been beaten up for a minute. The reason they've been beaten up is, why do I need a defensive stock when the market's pushing up higher, when I can just buy Micron and SanDisk and it only goes up? I don't need these defensive stocks. So they were sold off hard, but now they're starting to catch a bounce. Grocery stores, discount stores, right? These are the type of stores that are never going to go away ever, right? No matter how bad the economy gets, we still need grocery stores. No matter how bad the economy gets, we still need discount stores. So they are starting to catch a bid. Now, if we take a look into the grocery stores, 3 names really stick out to me: Albertsons, Kroger, and Sprouts Farmers Market. These 3 stocks right here are the ones that would show a little bit of promise to me. Now, if we go into Albertsons, first off the bat, like I said, I'm not surprised at all to see that this is beat up. But I'm not surprised at all to see it's found a bottom. I'm not surprised at all to see that it's found a bottom. In fact, let's go to ACI here in TradingView. And you can see that bottom right here. Now, am I saying that this is the absolute bottom? It has to go up from here? No, I'm not saying that. But I am saying you need to start putting these type of stocks on your watch list. Start rotating out some of the high flyer names that are getting absolutely monkey hammered recently, like ANET or IonQ or SanDisk or Western Digital or Seagate, and start adding in these type of stocks like Albertsons, right? When are we going to see this change? I don't know. But I do know one thing. It is on my radar to be taking a look at this stock. Another stock, Kroger's. Another stock that seems to be beaten up because nobody needs grocery stores when you got AI, right? Nobody needs grocery stores when there's AI to be had. But wait a minute. This just found a bottom right at an order block. Now, these order blocks represent areas where people want to buy, okay? This is an area that is full of buyers to help push the price up. And it's so interesting, so coincidental that it happens to be the very bottom right here. And it could absolutely start bouncing up at that point. And next, let's look at Sprouts. Sprouts Farmers Market actually looks like, no, I got a buy signal just a couple days ago. I was going to say, wait a minute, it still has a buy signal in place. Again, no surprise here that it's been beat up. But what you want to do on these type of stocks is you're not looking to buy the dips, okay? You're not looking to buy the dips because we don't know how far the dips are going to go. But as you can see right here, all 3 of these hit a bottom in the last couple days and are starting to turn around. You want to be buying the rips, okay? You don't want to be buying it as it's crashing down. You want to buy it as it's crashing back up. Now, it does have some overhead resistance right here, so just be aware. But these are the type of stocks that I need you to start taking a look at. Start putting them on your radar because there's a lot more going on under the surface than most people think. A lot more going on under the surface than most people think. The complacency has become rampant. The euphoria has become absolutely rampant, right? When there are no longer buyers, all that's left are sellers. And that's where I think that we are now at that turning point. We're now very, very close to that point happening. So if we take a look at the SPY, like I said, brand new all-time highs are just around the corner. Somehow it magically printed one red candle right here. This is unbelievable. Then you got the NASDAQ, which actually fell today, 2 days in a row that it's gone down. Call an ambulance. But the VIX still hasn't spiked. In fact, the VIX went down about 5% today. Another time that gives me more concern, right? When the market starts pulling back, the way that the VIX works is it measures the amount of put buying on the SPX index. We're seeing less and less puts being bought. Again, more and more complacency, more and more euphoria happening out in the marketplace. So let's go to rates. That's not rates. Actually, I want to go to put call ratio real quick. Yeah, put call ratio. Now, right here, what we see is that it's been aggressively bullish for a very long time, And only in the last day or two have we started to pick up and see somebody besides me saying, wait a minute. Maybe we shouldn't just buy all the calls. Maybe we should buy a couple puts every once in a while because things might not be as glorious under the surface as most investors think. So I'm not the only one who's thinking that. There's actually a change in direction here, and we'll have to see if it's sustainable for the put call ratio. One thing I did notice as well is that rates got something unexpected recently. Rates had a little pullback today, and that's definitely helped the price of stocks. But rates had a breakthrough, and not in a good way, in the difference between the 2 and the 10-year. Now, if this goes under 0, that is a huge red flag because that's an inversion, meaning that you can earn more on the 2-year than on the 10-year. Right now, it's not under 0, but it is moving more in that direction. We had a 46 basis point level that had held for a while, and now that's broken. We're down at 41 basis points. So the spread between these 2 points, the 2 and the 10, is getting tighter, and that's not what you want to see in a healthy marketplace. If you go take a look at the risk on sectors, they're not looking all that hot. In fact, look at the tech sector. Look at how big of a pullback that is right there. Then you've got the financial, the communications sector, which has fallen off a cliff. You've got the consumer discretionary, which has fallen off a cliff. But financials actually had a bid today. Financials have been going sideways for months at this point. Nobody is buying any financials. Then we go look at the risk off sectors. Okay, energy growing. Staples up a little bit. Had a big old red candle though, but still up net on the day. And utilities over here up as well, up about 53 basis points. Again, you're watching this turn under the surface. You can actually see this happen, which is really cool, right? But I gotta get you to understand. I am not a perma bear, perma bull, perma anything. I'm a perma opportunist, just like you are as a professional investor. So we need to be aware of what's going on out in the marketplace. That's what I want to get across here. Now, if these are interesting to you in the grocery stores, I got another video for you. In fact, we talk about discount stores. You want to watch this video right here, where we talked about 3 different stocks in the discount stores that you want to add to your radar as well. Be sure you subscribe, and I'll see you in the next episode.